Hello, everyone, and welcome to ECPI and Actuarial Changes. My name is Norman. I'm the training lead here at BGL, and I'll be your host for this session, where we're going to be running through ECPI, so Exempt Pension Income, some of the changes that have occurred over the last couple of years with, ECPI, and how it's going to affect or apply to the funds. And we'll also look at the actual process of obtaining an actual certificate in Simple Fund 360. Now, this webinar kicks off day 4 of our Simple Fund 360 Education Week. So if you weren't aware, we've been running webinars all week, about 3 webinars a day. Now, there's a list of some of the webinars that we've done throughout this week. And we've got a couple more to do with the next couple of days as well. Now, if you if you do miss any of these webinars, that's okay. To sign up for it, you will get a recording of those webinars as well that you can watch back at any time. Now, before we get into the content as well, just a little bit of housekeeping. Now, questions, if you do have any questions, and yes, we do encourage questions, please send it through to us at any time using the Q&A panel in your Zoom application. We'll be answering questions throughout the session, and I've also brought along some of my favorite people from BGL who are going to help me out with answering questions along the way. So we've got BGL members from our client success team, we've got guys from our support team, our training team, and even the Simple Fund 360 product team. So there's a lot of knowledge there at your fingertips, and it's a great opportunity for you to not only learn, but also clarify some of the concerns that you might have about using the software. So please take advantage of it. And also, we're going to have some time at the end of the session for some questions as well. So, if you have any questions about ECPI, hopefully we can help alleviate those questions. But also, if there's any questions about Simple Fund 360 in general, feel free to send that through as well. Also, the webinar is going to be recorded, like I mentioned before. All the webinars throughout this week are recorded, and they'll be up on our BGL community and our YouTube channel. So definitely head over there to check it out. If you weren't aware what the community is, it's a forum that we've created just for users such as yourselves to get in touch with other users. It's free to use as well. So head over to the community, create your account, view webinars that we've recorded. We'll post them up there, but also create threads and get in touch with other people that are also in the accounting field. Ask them questions, find out what's happening in the field, and also get some advice. And feel free to share advice as well. So ECPI, our topic for today. As I mentioned, the focus of this session is around ECPI. Now, we ran a session previously on pensions, and there were a lot of questions, which we did anticipate, especially around ECPI. Now, due to this, we had planned and dedicated a session just on ECPI, because again, we knew there were going to be a lot of questions around it. We do find that, especially from the changes from ECPI over the last few years, it's caused a bit of, uncertainty and confusion around how this kind of applies to your funds and what do you need to do differently when processing your funds. So much of this session is actually going to be around building your knowledge around the methods and the terms that have to do with ECPI. Because when we get to the actual program itself, you're going to find that the actual processing is quite simple and really easy to use. We've developed it in a way that is very easy to use. But especially more so if you have that knowledge or that build-up of knowledge to understand what's going on. Definitely does make it easy to use. So that's what we're running through today. A lot of it is going to be based around those terms and things like that. Now, the first term we're talking about is segregation method. Now, when we're calculating exempt pension income, there are really 3 main methods that are used to calculate the actual exempt pension income amount. And this is the first one. This is the segregation method. Now, definition under the segregation method is where assets of a fund are segregated current pension assets if the assets are identified as supporting retirement phase income. Anyway, in a nutshell, what that means is, let's say you've got a fund, you've got pension and accumulation members. You have assets, investments in the fund. If you have specific assets and investments that are used to support specific members or member accounts, any of that income or capital gains or whatever happens with those investments go directly to those members, to that specific member. If that member was in pension, then any income derived from those investments for that specific member is going to be tax-free or exempt pension income. And that's what the segregation method is. Now, what we do find as well is most funds aren't using the segregation method. Now, in the chat, what I'm going to post to you is an article that we have on how to segregate a fund. Now, later on in the session, I'm happy to go through actual segregation, but if you want a help article on segregation, we've got an article there in the chat around segregation. Again, most of the funds don't use this method, but you can segregate a fund. You can segregate a fund at the start of the year or throughout the year and specify which investments are allocated to which members. And because of that, whatever is allocated to a pension member will be tax-free. Now, the next method is going to be your proportionate method. There we go, proportionate method. Now, the proportionate method definition calculates exempt portion of income based on the proportion of total liabilities or fund liabilities that are current pension liabilities. Basically, this is your actuarial certificate method. This is where you would go and get an actuary certificate. It'll give you a percentage of how much the fund can claim for exempt pension income, and that's how much you can get off your income for the fund or deduct from the income of your fund. So this is another way to think of it is your actuarial certificate method, okay, in simple terms. Again, you get a percentage and it'll tell you how much is exempt pension income for the fund. Now, the percentage in simple terms is going to be based on a lot about the member balance. So it's a proportion, or it's calculated based on a proportion of the member balance relative to the fund and the other members of the fund. Now, your next method is going to be it's going back, there we go, deemed segregation. Okay, so this is the third method. Now, this was introduced in 2017, but it's almost a hybrid method of the proportionate method. This is still a method where you do get the actuary certificate, but it works a little bit differently. So again, they introduced this in 2017. Now, within the definition, if at any stage during the year, if there are any periods or where the assets are solely supporting a pension account, then that's deemed to be segregated. So what that means is I'm going to bring up an illustration just to hopefully make it a bit easier to understand. Let's say this is an illustration of the fund and how it's in accumulation and in pension phase. So this is an example of a 2-member fund, let's say. You've got one member that's in pension throughout the year. You've got another member that's in accumulation for part of the year. And then on 1 of March, they decide to go into pension. Now, what you're going to find with this fund is at the end of the year, that part end of the year from March to the end of 30th of June, that whole period, all the members of the fund is in pension. Now, under deemed segregation, again, introduced in 2017, for that last part of the period, that's deemed to be all in pension. So in that last period of the year, all that income or anything that's derived from that year is going to be in pension. So it's thought of as a full pension phase within that period of time. Now we'll go through some, I guess, a comparison between the proportionate method and also the deemed segregation method and how that is slightly different. So again, as I mentioned before, both methods will require you to get an actuary certificate, but how they apply to the fund is a little bit different. So 2017 and prior year treatment, this is, again, the proportionate method before it changed to the deemed segregation method. And it's still important to know both methods because from 2022 onwards, it's going to be a little bit different. So your first section is the proportionate method, so without deemed segregation. In that scenario, what would happen is you would obtain an actuary certificate, and that percentage that you get from the actuary certificate is going to apply for the full financial year. However, under the next or the second illustration, we can see there what happens when deemed segregation now applies. Now, when deemed segregation applies, you still get an actuary certificate, and that's the second table or second illustration. But the actuary percentage that you receive from that certificate is only going to apply for that first part of the year. For that second part of the year, that whole period from where all the members are in pension, everything is going to be tax exempt. Okay, so everything is going to be, any capital gains is going to be exempt under Exempt Current Pension Income. Any of the income is going to be exempt under Exempt Current Pension Income. But again, you'll still get a percentage, and that percentage will only apply for the period that you had a pension account and an accumulation account. Okay, so that's the difference between both. So hopefully that does make sense there. Let's go through our next term. Our next term is going to be a disregarded small fund assets. Okay, now this, as well as deemed segregation, was introduced in 2017. So, and it applied from the 2018 year onwards. Now, definition. This is the definition they give you, and I'll simplify it. From the 2017-18 income year onwards, you will need to consider if your fund holds disregarded small fund assets, as this may affect how you calculate exempt current pension income. Now, this term disregarded small fund assets, actually, despite what the name suggests, has little to do with actually assets and more to do with imposing restrictions on certain funds. Okay, now, when I go through, I guess, the history, but why this came about, hopefully it makes a bit more sense. So back in 2017, if I take your mind back, one of the things that was introduced in super was a cap, a $1.6 million cap to pensions, meaning no one could put more into pension over $1.6 million. Now, the idea with imposing this cap was to generate more revenue for the government to get money out of super from these high earning individuals. Now, when lawmakers were making this law about this $1.6 million cap, one of the things that they were worried about people with more than $1.6 million is that they would use methods like the segregation method to try to avoid paying more tax. So if you've got more than $1.6 million, you've got a pension account, you might decide to use, because of this new restriction, you might decide to use the segregation method. You might decide to go, hey, I'm going to allocate all the high earning investments. I'm going to allocate all the investments that are going to generate a lot of capital gains to my pension account, and anything that's learning less income or causing more expenses or causing capital losses, I'm going to allocate that to my accumulation account now, and that way you can avoid tax. So what the lawmakers decided to do was introduce this rule. Essentially, this rule tackles or pinpoints certain funds and says, hey, you can no longer use any segregation method. You must use the proportion method. Therefore, you must get an actuary certificate. Again, to force certain funds to getting actuary certificate. So again, it has very little to do with what types of investments funds are having, and more to do with restricting certain funds. Now, if you look at the requirements under what a fund needs to have to be regarded as a disregarded small fund assets fund, these are the points. So a fund is deemed to have disregarded small fund assets when, under these 3 points, I've got one in red, so we can ignore that for now, but the fund is paying at least one retirement phase income stream, so has a pension. The fund has a member with a total super balance over $1.6 million. And the fund, that particular member is receiving a pension. As you can see there, it has nothing to do with really about actual assets and identifying what assets the fund has. It has more to do with, again, picking out certain funds and restricting them from using certain exempt pension income methods. So let's break that down a little bit further. So first point is the fund is paying at least one income stream during the year. So anybody within the fund has a pension account. That's the first condition. The second condition is a fund member has a total super balance of over $1.6 million immediately before the start of the income year. So at the 30th of June or of the 1st of July, at the start of the financial year, you will check the members' balances and ensure that each member is either over or under $1.6 million. Now, total super balance refers to the accumulation of all the accounts that person has, that individual has. So if a person has an accumulation balance and a pension balance, you're adding that up and seeing if it totals over $1.6 million. Also, you're checking if that person has any other super funds around. So they could have an industry fund or any other super funds out there. You're combining all those balances together to see if that person has over $1.6 million. Now, if that is also satisfied, the third point is that member is also receiving a retirement phase income stream. So that means, is that person receiving a pension from any of those income sources, specifically that person with over $1.6 million? If the fund satisfies any of those three tests, that means that person falls, or that fund in particular, falls under the disregarded small fund assets. And that means that fund can no longer use any of the segregation methods for exempt pension income or deemed segregation method for exempt pension income. They can only use the proportionate method. That means they obtain an actuary certificate. Now, the last point there, after 1 July 2021, the fund is not in 100% retirement phase at all times of the income year. Okay, so they recently added that for the 2022 financial year, another check. So if the fund is in full pension, 100% pension, then they don't need an actuary certificate. But beforehand, if the fund was on top of all those, even if they were in 100% pension, they'd still need an actuary certificate, which is a little bit silly. But I guess after the fact, they've added that check as well, especially now that they've increased the cap from $1.6 million to an index $1.7 million. So you have more funds that have more than $1.6 million that are also in 100% retirement phase. So that's why they've added that extra check. Now, this is a check that you would do, I guess, using the figures of the fund at the start of the financial year, but you can also check just as you're doing the actuary certificate application. Okay, and again, that just to confirm that if it does satisfy those conditions, you can only use the proportionate method. So when do you actually need an actuary certificate? So again, when you're using the deemed segregation method or the proportionate method, and you've got a member in the fund where you've got a period where the fund is in accumulation and you've got members in pension, you would need an actuary certificate. Okay, if you're using solely just the segregation method, then you don't need an actuary certificate. Okay, but again, if you're using the proportion method or the deemed segregation method, you will need an actuary certificate. Also, the timing. This is where we get a lot of questions now, especially with these changes and with deemed segregation, where only part of the year needs an actuary certificate. When do you actually go ahead and apply for one? Do you apply for one partway through the year, or do you apply for one at the end of the year? And just to confirm, you only need one actuary certificate for the fund, and you would obtain this at the end of processing the financial year. Okay, so after you've done all the transactions, you've recorded all the events for the year, after the fact, after you put the members into pension, then at the end of the year, you would then do your application. As part of doing the application, you would send the figures to the actual provider. They'll look at everything that's happened throughout the years, all the events, all the pension starts and things like that, then create the percentage based on all that information. Okay, so again, hopefully that clarifies that question. When do you need to actually obtain an actual percentage? Okay, now further onto that, you generally do not need to run the 30th of June credit entries before applying for the actuary. Now, this is a question that we have. Do I need to run credit entries or not? Now, it does. There are exceptions to that. Now, we do have an article. I'll send to you via the chat. So have a look at that, have that on hand, and it's readily available to the public. So you can always look at this at any time. But this is all the actuary providers that we have integrated Simple Fund 360 with. But not only that, this table will tell you whether you need to do credit entries or not before applying for the actuary. For the vast majority of them, you do not need to create entries before applying for them. The only exceptions to that are going to be Heffron or Versus or Verus. So those two are the ones that you have to create entries before you apply for an actuary certificate for them. Okay, now we have questions about what if I have credit entries partway through the year? If you have credit entries partway through the year, you don't have to reverse them as well. Despite saying that you're not required to do credit entries for any of these, if you create entries before applying for an actuary, even if it's not required, that's okay. Okay, you can still have those credit entries in there. It's not going to really affect anything. Okay, so if you find it easy just to keep the credit entries in there, go ahead and do that. So keep the credit entries in there if you've already done it. If you haven't done it, then it's no big deal, as long as it's not required by your particular provider. Okay, now we've got a question, good question. Is there any reason behind it? Why you have to create entries for a couple of them, but you don't have to create entries for some of the other ones? A little bit. So what I would say with the providers, they calculate things or they look at things a little bit differently. They'll ask for different information. Most of these providers will only really ask you for member type information. So things like member balances and at the start of the year and things that have happened throughout the year, like contributions, pension payments, and things like that. Some of them will also ask for additional information like end of year balances and profit allocations and things like that. Okay. With the credit entries process, it does things like revaluations, profit allocations, and things like that. A little bit extra information that some providers will ask for, as opposed to others. Some providers won't ask for it because they feel like they don't need it. So that's why some of them will request that you do the actual credit entries process, and some of them, most of them won't require it. So we'll actually go through the actual process of going through the actual application. So what I'm going to do is I'm going to flip over to Simple Fund 360 and we'll finally see how this looks in action. So I've got Simple Fund 360 open and I'll flip it over into my screen. Now, here I've got a fund ready to go. I've processed all the transactions for the fund. I've got a fund with some accumulation members partway through the year, and at the end of the year, all my members decided to go into pension. To apply for an actuary, you can do so from Simple Fund 360. From the left-hand menu, we're going to head over to members. And from our members, we're going to head over to fund pension policies. Now, in our fund pension policy screen, this is what it's going to look like. On the right-hand side, you're going to see the option to add or request a new actuarial certificate. So we're going to select request actuarial certificate. We've got the option to request an actuarial certificate and the year that we want to request an actuarial certificate for. At the bottom, we select request actuarial certificate, and then we've got the option to pick the provider. Now, it's really up to you who you pick. Before you apply for it or during this application, you do have to create an account with those providers. So you would pick whichever makes sense to you. Maybe you already have a plan going with one of these providers, or I guess, kind of deal with one of these providers. It's really up to you. We do support all of them. So I'm going to pick the provider that I'm with. I'm going to pick Act 2 and click on Next. So, but again, you can pick any of the providers there. I'm going to confirm my details. So this will be based on my login details and my profile details. I'm going to click on Next. And then it's going to give me some questions. And these questions are based on some of the theory that I've just gone previously. Okay, so below, you've got options on please confirm the fund's eligibility to use the segregation method. So this is talking about the disregarded small fund assets rule. Okay, so you're going through all those dot points and picking out, hey, does the fund satisfy those dot points? If it does, then that means it can't use the segregation method. If it doesn't fall under those criteria, then it is allowed to use the segregation method. Okay, so again, you're going through those criteria. Now, if you do forget what they are, if you look above, you'll be able to see them listed here. Okay, so in this screen, you're looking at those checkpoints, you're double checking with the fund if it does satisfy those. So here you would specify, okay, can the fund use the segregation method or not? Let's say, just for argument's sake, for this particular fund, we're going to say, yes, the fund is eligible to use the segregation method, so it doesn't fall under those dot points there. At the bottom there, you've also got another option. Okay, now this is now for the 2022 financial year. You'll get another option that you have to select and you'll have to determine for the fund. You have to pick, you have a choice now, whether you can pick the proportionate method or you can also pick between the deemed segregation method. So do you want to receive a percentage for the entire financial year, or do you want to use that deemed segregation method? And again, we went through those scenarios of how it does differ. Now, a little bit later, I'll talk about what you might have to consider between those two, to choose between those two. But again, just illustrating to you there that you do have a choice now, and it does work a little bit differently. I'm going to select the deemed segregation method just to show you how that looks in the program. And we're going to click on Submit to Actuary. Now, when you click on Submit to Actuary, it will start getting the figures for the fund and sending it to your actual provider. Okay, now here we've got the application. Now, if you haven't got an account with them, when you head to this screen, it will ask you for login details so you can create an account yourself from that screen. But as soon as you log in, you'll see the application and you can see everything's filled out. And essentially all you'd have to do is select Request Certificate at the bottom of the screen. When you click on Request Certificate, then you can go ahead and process the payment for that Actuary certificate. Now, back into Simple Fund 360, before we go through the payment, you'll see there the program actually pre-fills an estimated percentage. If you look back in that article that I've sent to everyone with the actual providers, including whether you need to do credit entries or not, there's also a column whether the provider also provides an estimate percentage. And this helps you identify which method you want to use as well. So you can go into the percentage, you can view what the estimated percentage is and see if that does look good to you. Now, when I look at this percentage as well, I also want to avert your attention to the segregated method as well. Now, if I select the method of deemed segregation, it will show me the periods within the financial year that all the members are in pension. And you can see that the program's automatically done that. All I've had to do is just record things as I normally would, put the members into pension as I normally would. And then the program has been able to identify that, hey, the fund is in full pension for this period of the year. So this period of the year is going to be exempt from pension. For that other period of the year where everything's based on the actuarial percentage, that's going to have the percentage here that's going to apply. Okay. Now I'll put this note as well. Choosing between the proportionate method and the deemed segregation method. So if you've got a fund where you have the choice of picking between both, choosing between the method, just to confirm, is going to give you a different percentage. Okay, so if you pick a proportionate method to a deemed segregation method, the actual providers are going to give you a different percentage based on both. Now, the reason why they give you a different percentage is because under the proportionate method, it's going to take into account the full financial year, even the period that all the members are in pension. So naturally, it's going to give you a higher exempt pension income or actuary percentage. Whereas the deemed segregation method is going to completely ignore the period where all the members are in pension and only look at the period where the members are in pension and accumulation. Okay, so naturally it's going to give you a lower percentage, but you're going to have that period where all the members are in pension. So although we can't give you financial advice, at least this is your starting point, and this is a major consideration you can take into account when deciding between both. Your major consideration is going to be really around your timing of transactions. So you've got to ask yourself, for the fund, where do the income and the capital gains fall? Are they occurring in the periods where all the members are in pension? If so, that means you're likely to see all that income and all those capital gains to be exempt for tax. Ask yourself, are all the expenses or all the capital losses, do they fall in periods where there are no pension accounts or there's accumulation accounts? If so, then that means all those expenses are going to be deductible. All those losses are going to be deductible as well. So those are your major considerations when choosing between those two methods. Also, what I will say is you can actually use Simple Fund 360 to calculate this for you and to find out the best result. So instead of you actually going into the fund, looking at the reports to figure out, okay, which one's going to give me the best result, you can actually use the fund pension policy screen to figure that out. So if I go into the fund, I'm going to go back into Simple Fund 360. I've now done an application where I've applied to Act 2, saying that I want to apply under the deemed segregation method, and it's given me this estimated percentage. Now, if I wanted to, I can look at the report, see how that looks at the end of the financial year and go, okay, let's see what it looks like if I just decide to use the proportionate method. Then I can go through the same process again. Again, I haven't paid for the actuary certificate. I've just put my application through and they've given me an estimated percentage. I can put another application through and get an estimated percentage under the proportionate method, see how that looks, and then whichever I'm happy with, go ahead and purchase that one. So let's do that now. Let's go through the request with Act 2 again. And I'm going to select the proportionate method this time and submit it to the actuary. Now this time, when it submits that, I'm going to go back into Simple Fund 360 and see what percentage it gives me this time. Now, if I look at the percentage, you can see that there's no periods where you've got segregated pools because I haven't selected the deemed segregation method, but instead it's given me a full percentage of 95%. Again, it's a high percentage, but then that way you can use it to identify which is going to give you the better result at the end of the year. Again, without me having to agonizingly go through all the reports and figure out myself. You can use those estimated percentages to figure out what is better for you. Once you get the best result, then you can go ahead and pay for it. Okay, now we've got some questions. So we've got a question around some providers like Accurate and things like that, where they do require you to pay for the actuary first before applying for the before getting the actual percentage itself. So they won't give you the estimated percentage. Now that's okay. With Simple Fund 360, you can easily do amendments to your actuary's applications. So let's say that you do an application for an actuary percentage, you get a percentage for deemed segregation. Then later on, you might want to do the application for the proportion method, and you want to do an amendment for that. Or maybe you've done more transactions and you want to do an amendment for that. You can do it easily from the software itself, and it won't charge you again. So to do that, let's say that I go into this fund, I'm going to just quickly add a transaction. And I want to also show you something a little bit different that the program does do. It just identifies that something has happened in the funds. So I'll bring this fund up. So it'll just be a quick moment. Okay, we're going to head back into the fund pension policy screen, and I'll refresh my screen. Okay, so this particular fund, similar fund, we've already applied for an actuary certificate, but let's say that we want to apply for another one, maybe under another method, or maybe that we've added transactions after the fact. Okay, now with the when you post transactions after applying for an actuary certificate, you'll get a warning message in the screen saying that, hey, you've got transactions after applying for an actuary certificate. You can resubmit or do an amendment to get a new certificate. Now, the actual amendment process is exactly the same as doing an application. So there's nothing different that you do in the software. You just go ahead and do the application. So this is, again, what it's going to look like. You're going to click on New Actuarial Certificate, and you're going to go through the same process. Pick your provider, click on Next, and answer the questions as they apply. And that's essentially how you do your amendments. Again, that sends it to your actual provider. And because we've got full integration, because we've got full integration, they'll be able to identify that you've already done an application for this fund, that this next application is going to be an amendment. Okay. So that comes to the end of the content for today. So hopefully that's clarified a few things about how ECPI works now, and also some of the changes and how to actually apply for one in Simple Fund 360. So hopefully that's been a really useful for you. Okay, I think we'll end the session there. Thanks everybody for attending and your time. Hopefully you have found this valuable, and thank you everybody for sending your questions through. Hopefully we've been able to clarify a few things about Simple Fund 360. So we'll end the session there. Again, thank you for your time. We really do appreciate it, and we hope to see you for a future session. Thanks.